Good afternoon, everyone, and welcome to the second NPR of the year. We are releasing the October edition of the NPR today, and with us we have our NPC members. We have the Governor, Leseja Kganyago. We also have Deputy Governor Kuben Naidu, Deputy Governor Rashad Kasim, and Deputy Governor Fundi Sibana. With us as well is Chris Neufeld, who is the head of the Economic Research Department. Kindly note that we are live streaming this session through our YouTube channel as well as on Facebook. You may also send us your questions through the webcast, so we look forward to hearing from you and engaging with you. Again, thank you for joining us today. I will now hand over to the Governor.
Thank you very much, Paul and MPC members, attendees at this virtual and last monetary policy forum for 2021. Who thought that we would still be here? But truth is, it's almost 2 years since the outbreak of the COVID-19 virus. After a sharp contraction in economic activity in 2020, the outlook is more upbeat, though still uncertain. The IMF projects global growth to reach 6% in 2021 and 4.9% in 2022. As the South African Reserve Bank, we have revised our own partner GDP, trading partner GDP over successive MPC meetings as growth has surprised on the upside. No country has been spared by the virus, and yet economic impacts have been vastly different. Most advanced economies are expected to surpass their pre-COVID-19 levels of output this year, while emerging markets are still contending with the scars of the pandemic. The clearest factor of separating economic recoveries has clearly been the rate of vaccination. Our own economy has shown great resilience, rebounding sharply to within 1% of the 2019 level by the second quarter of this year, following the 6.4% contraction in GDP in 2020 and despite various setbacks. The recovery has benefited from the robust global demand for commodities and supportive domestic economic environment, except for the July riots, of course. But this resurgence in commodity prices could actually breed complacency. There might just be a narrative that seems to suggest that we are once again in a commodity supercycle. And there is a risk that commodity producing and commodity exporting countries might start to live as if they are richer than what they actually are. South Africa, as a commodity exporter, should guard against this complacency. And this complacency could creep in, including us making commitments and expenditure outlays that we might not afford outside of the rising commodity prices. And indeed, there are indications that the commodity prices might be correcting. And if they do correct, that could mean that we would be facing risks that we didn't think about earlier in the year. Thus, the primary sector has led the recovery, while the secondary sector continues to lag. The tertiary sector is in between. The headline inflation trajectory has remained relatively contained and is expected to remain around the target midpoint over the forecast period. The Monetary Policy Committee kept the repo rate steady at 3.5% for 7 consecutive meetings, despite rising inflation risks, showing difference to the economic recovery. Many emerging markets are grappling with sharply rising inflation and have begun reducing policy accommodation. In South Africa, domestic factors have largely countered global inflationary forces, enabling the MPC to keep the repo rate at the current levels. However, South Africa is slowly but surely running out of runway. We should begin to rebuild policy space as the economy completes its recovery. Speedier vaccination and implementation of the structural reforms should further strengthen the recovery and support more balanced and sustainable growth. With those few remarks, let me hand over now to Chris Lovald, who will take us through a synopsis of the monetary policy review that we are publishing today. Chris, over to you.
Thank you, Governor. I'm just going to see if I can successfully share my presentation.
We can see it, yes?
Good. All right, great. Thanks very much. Let me start off by thanking the project lead for the MPR, Witness Simbana Gave, and his team of very dedicated and hardworking staff that put this document and presentation together for us. So my task is, as usual, to present a set of pictures that speak to the monetary policy review and the document, and I obviously encourage you to read it from cover to cover. So what do we want to talk about today? Certainly we'll show you a bit about what the global recovery looks like. It has turned out to be stronger than we had expected, but it is also diverging in important ways, and I'll talk a bit about that. There is a combination of strong demand with supply bottlenecks, which are stoking inflation in certain parts of the world and generating some concern about what policy in particularly advanced economies will look like going forward. And that's generating, as it always does, quite a bit of volatility in global financial markets. So far, normalization is expected to be gradual in advanced economies, and I'll show you why. I'll talk a bit about commodity prices and how households have underpinned the South African domestic economic recovery. And I'll also show you what South Africa's inflation rate looks like, why it's contained, and what the risks to the upside look like. Repo normalization is something we've talked about in the MPC statements, and there's a discussion of that in the MPR. And this is really about trying to manage, as we go through the recovery, what accommodation levels are doing to the economy and to the inflation rate. As usual, I'll try to go through quite a few slides relatively quickly so we can get to the fun part, which is the questions period. So this is what trading partner GDP growth looks like. You can see right in the middle there that 2020 collapse in growth, and then 2021, this very, very strong recovery. We've broken it down by trading partners, and you can see it's really quite broad-based. With China, the red bit, one of the portions of the economy, global economy, that has accelerated out of the pandemic relatively quickly and helped to generate this very strong 2021 growth outcome. But various parts of the world have done pretty well in 2021. Going forward, the forecast starts to fade, and this is a kind of broader theme that we'll come back to later today, but also you'll hear discussed in coming weeks by various institutions and analysts out there. Because one of the big questions is, what does that fading growth in the rest of the world look like, and what will the sources of growth going forward turn out to be? Certainly, much of the recovery from the pandemic is diverging along the lines of vaccination rates. This chart just shows you this very nicely about how vaccination rates per 100 people are rising to the right-hand side of the graph. And then on the left-hand side, we're measuring on the y-axis there, the Manufacturing Purchasing Managers Index. And it's worth noting this group of countries here, which includes South Africa, where our manufacturing levels have actually bounced back pretty well, despite having relatively low vaccination rates. But you can see how better vaccination outcomes moving to the right should generate a more sustainable growth, as that's what we've seen in other countries. More broadly, advanced economy growth rates have been revised up. These are the IMF's projections, and I'm showing you that in the middle two columns for 2021 and 2022, you can see how growth has been ticked up between April up to July. So over a very short period of time, the momentum of the economy has registered higher for advanced economies. But for emerging market and developing economies, it's not quite looking as rosy. And in particular for 2021, there's been a bit of a marking down of the growth rate. 2022 is still up a bit, so there's a bit more optimism for that recovery, but 2021 is a little bit lower. Moving to some of the outcomes of this recovery, that relate more directly to monetary policy. You can see in what I'm showing you here are two different graphs showing how strong demand is picking up on the left-hand side, and that's demonstrated by this global PMI and global trade volumes, and you can see how these have moved quite a lot higher than their pre-pandemic levels. So demand is strong, but it is generating a price response, and this is attributed by and large to supply bottlenecks and other factors which are lifting producer prices quite aggressively. The emerging market commodity prices is that blue line, and that's measured on the left axis. I'll come back to that number because, of course, that's been of some considerable benefit to South Africa and other emerging markets. But those commodity prices are playing into advanced economy OECD producer prices, which are measured on the right-hand side, growing at 10–12%, which is quite high indeed. When we look at how producer prices are feeding through into global inflation and advanced economy inflation, it is picking up in the CPIs, and I'm showing you this in two different ways here. On the left-hand side, you can see what G3 inflation rates look like, and in particular, the US has picked up that blue line. And then on the right-hand side, how in a set of countries, those CPI numbers are also feeding through into core inflation. So in these countries, you're not getting this kind of divergence between a weak core inflation and a stronger headline. The two are actually moving together. But other countries aren't experiencing quite the same strength of inflationary pressures. Inflation is still considered to be transitory in advanced economies. This graph shows you what advanced economy inflation forecasts look like over the next couple of years relative to the long-term mean inflation rate. Which is from 2015 to 2019, and that's that solid line sitting at 1.5%. So for 2021, on the left-hand side of the graph, you'll see that dotted line is really quite high, going from 2.5 to 3%, so almost double the average, the long-term mean inflation rate. And then into 2022 and 2023, these inflation rates are expected to soften, and so that gives a bit of an optimism that policy may not have to react as strongly to this inflation rise as has been feared in the past. And for those of you who read the Financial Times or watch the Bloomberg TV, you will see that this is a daily debate. This assessment of policy risk and whether or not global major central banks globally will have to respond does create quite a bit of financial market noise. And this is some of the detail that the analysts are looking at. On the left-hand side, you can see how the Fed funds rate projection has changed over time. And so you see the FOMC's September 2020 meeting, their March 2021 meeting. Nothing's changed. They expect this very low Fed funds rate. And then suddenly by June 2021, you start to see a shift. And in the outer year of the forecast, the 2023 number, that's that red column, you start to see that the median projection for the Fed's funds rate is going up quite strongly. You see another version of this on the right-hand side with the G4 monetary policy rate forecasts also rising from levels sitting about 0.1, 0.2, 0.3, up to something more closer to 1% over the next 2 years. Unlike advanced economies, inflation is sharply higher in emerging markets, in many emerging markets, and targets are under pressure. This graph just shows you a cross-section of emerging markets from Russia on the left to Malaysia on the far right, and shows you the deviation of their latest inflation rates from their target. For many of these countries, the headline rate is what's really moving. Brazil on the left-hand side is a good example of that, where the headline inflation rate has picked up very strongly, but core has been more modest. Russia on the far left has seen a stronger core rise than a headline rise. And then South Africa is on the right-hand side with a bunch of countries where even though the headline rate is slightly above the target or the midpoint of the target, core remains a little bit lower. And I'll talk a little bit more later on about what that implies. But we're in reasonable company. Indonesia, Thailand, and Malaysia all are seeing core inflation rates that are remaining low. Certainly, emerging market central banks are moving as a response to these inflation rates to reduce accommodation. So on the left-hand side, that kind of, I don't know what color that is, aqua blue color, shows you the changes in interest rates done by a wide range of emerging markets between January 2020 and the end of March 2021. And almost all economies lowered their policy rates quite substantially. South Africa is on the second from the far left. And then since the end of March 2021, a range of these economies have had to raise rates in response to those higher inflation rates I showed you on the previous graph, Brazil, Russia in particular. And on the right-hand side, we're looking at that easing and tightening balance of policy moves over time. So this graph runs from January 2020 up through September, and you can see how you're getting more tightening moves as we move past March, and that is pushing up the weighted average policy rate, which we measure on the right-hand side of this graph, up to something like 4.5%. Across the 26 countries that we looked at in this particular group. South Africa's domestic economic recovery has been strong. This is what it looks like in level terms, a constant billions of rand. And you can see how the economy has responded on the right-hand side of this graph to try to get back up to that 2019 level. And I think, by all accounts, this has been a quite robust response. But it remains uneven, as the governor noted in his introduction, and in particular on a sectoral basis. On the left-hand graph, we're just showing you how you break this down by primary, secondary, and tertiary sectors. And in particular, that secondary sector has struggled to get back up to that 2019 level, whereas primary sector like mining and agriculture have done quite well. Well, mining's boomed back and agriculture did very well throughout this kind of period. And we've seen more recently the tertiary sector picking up better and getting back up to that 2019 level. The graph on the right shows you another view of this, in particular shows you that the construction sector which is a relatively small component of the economy, but features heavily in the secondary sector of the economy, remains really very weak indeed. Other sectors like transport have struggled to get back to those levels, and of course, the tourism and hospitality industry remains very weak still also. At the same time, as part of our GDP revisions, what we've found is that gross fixed capital formation as a percentage of GDP has come out a bit lower, and that suggests that potential growth rate of the economy remains constrained. One view of that is looking at the electricity shortage, and on the right-hand side, the right-hand graph, I'm showing you what the net energy sent out per year looks like. And you can see 2021 is in blue, 2020 is this orangey kind of line, and you can see how that collapsed last year. Obviously, it's doing much better in 2021, but remains below the 2019 level. And this is all suggestive of one of the things we talk quite a lot in the NPR about, which is this weak potential growth rate of the economy. The recovery has certainly been supported by both monetary and fiscal policies. The left-hand graph shows you how the real repo rate has been dropped relative to what we think of as being a longer run neutral real rate level, which is the green. And that blue line, the gap to the green line, is the extent of accommodation that's being provided to the economy. And you can even see into 2021 how that accommodation has deepened. So there is more policy accommodation being provided relative to nominal GDP today than there was even 6 months ago. And on the right-hand side, numbers that will be familiar to many of you, government expenditure in nominal terms over recent years. This is the growth rate, and you can see how in 2019, 2020, government expenditure ramped up to provide additional support to the economy through various channels. Another factor that has helped us adjust to the pandemic shock and kept the economy afloat in certain ways are elevated commodity prices, and these have really been a unexpected boon in many ways. They've lasted for quite a long time. You can see on the left-hand graph, the commodity prices actually have been rising for a couple of years before they really accelerated very aggressively into 2020 and through to 2021. They have started to turn, however, and again, the governor flagged this earlier in his comments, and that has some repercussions for us. But up to now, it's been very positive for the recovery, and in part because of what it's done for the trade balance. Part of the trade surplus that we've achieved has been stronger export commodity prices, which have flattered and pushed up very aggressively export numbers. And on the other side, more negatively, has been a collapse in imports, which is just now coming back to kind of 2019 levels, but certainly in the middle of 2020, were very low indeed. And so that generated this cumulative trade account outcomes that were very good, both in 2020, which is the orange columns, and into 2021, which are the black columns. And that's reflected in the balance of payments on the right-hand side, with this very large current account surplus that's been achieved. And then you can see that current account surplus dissipating over time, down to about a surplus of 0.7% in 2022, and then moving into deficit in 2023. And that's part of our forecast as the economy normalizes. So apologies for testing you with that particular slide, lots going on there. The recovery has also occurred in terms of workers' earnings. Total compensation of employees on the left-hand side, the growth rate picked up very strongly this year. But when you break this down by compensation by sector, again, as you will know, and many of you experience, and you would imagine, the sectors that are trailing are struggling to raise their compensation levels, and also, of course, struggling very hard to rehire people. And this has got implications for the economy as well. We've seen stronger household consumption, in part because those compensation numbers have come back. I'm showing you compensation, our forecasts over the years, but you can see here, I've just sort of shaded it, what 2021 looks like. We've actually had to peg up or push up our household consumption numbers over the course of the last few months. Now, I referred to the job losses. This graph, I think, is quite a nice one because it shows you from a kind of economy-wide volume perspective what the pandemic did to our overall level of the labor force and the employed, and that's that bit right here on the right-hand side. So what we're measuring here are millions of people. And that top line shows you the total population, working age population. The gray component of that is the part that's not economically active. The red component is the number of unemployed, and the blue is the employed. And what you can see there on the right-hand side is that the pandemic caused a sharp drop in employment. Also a sharp drop in people looking for work. So the unemployed, the number of the unemployed fell and the non-economically active increased. And now we're seeing reversal of that where as the economy starts to pick up, more people who were not economically active before during the pandemic are re-entering the labor force. And so that unemployment rate has picked up quite strongly. Again, commodity prices have also benefited our fiscal position. I'm just showing you this on the left-hand side through the gross operating surplus. So the mining sector in particular, that's that red column, has done very well from the commodity prices. And then that's fed through into tax revenue collection, in particular in company income tax, which is CIT in that shaded bar. But taxes generally across the economy have done well, as you could have done better than expected, I should say. You can see that the red bars are all above what the blue Q1 average was from 2015 to 2019. And that is, again, symptomatic both of the commodity price boom, but also the robustness of the overall recovery. This has helped to lower near-term fiscal risk, and the South African risk premium equilibrium has come down. That's what I'm showing you on the left-hand side, and the way in which that risk premium equilibrium has kind of deflated back to a level that is still high in historical terms, if you look at the blue line there, but it's certainly back closer to what we would have expected it to be. And then another kind of view of that is the South African sovereign bond curves on the right-hand side. And what I'm showing you here is the blue on the right, which shows the 25th of February 2020 bond curve. So this is right around the time of the 2020 budget. And then the green is what that sovereign curve looks like today. The front end has come down a bit as our repo rate reductions have played a role there, while risk still remains high and in large part because of just these kind of global uncertainties we've talked about, and lack of clarity about how the global recovery will work, and a still high fiscal position and borrowing needs, which remain. Let me switch now a little bit to inflation. This is the most kind of recent short-term inflation view. between the July and the September meetings. The July is in the red and the black is the September outcomes. And we're just running the numbers up through the end of December here on a monthly basis. And you can see how things like higher fuel prices, food prices, and a little bit of underlying core prices have changed that headline inflation forecast in the near term from sitting at around 4.4%, 4.5% up to 4.8, 4.9, and then in the outer months of this year up to 5.1. So there are some risks that are front and center for the MPC to look at. Non-core inflation has been underpinned by elevated food prices. So one of those components in the previous graph involved food. And part of the reason for that is what I'm showing you here on these slides, which is on the left, the global food inflation picture, which has accelerated very, very aggressively indeed. And on the right-hand side, what South Africa's inflation rate looks like for food and non-alcoholic beverages from meeting to meeting of the MPC. The actual has been the black line, and so the point really here is that food inflation, while it's rising, has been more moderate than we had expected it, say, a year ago. And it's been pushed out. That's that red forecast line, despite this very aggressive global food inflation story, which you can see that has played itself out on the left-hand side. That left-hand chart, the right-hand component of it, of course, is our forecast. So we expect global food inflation for various kinds of reasons to start coming off. But of course, one can always be surprised by these things. Fuel inflation has also been very high, as you will all know, and in double digits. The Rand price per liter is on the left-hand side for petrol and diesel, and you can see how that has accelerated. And on the right-hand side, the fuel inflation number hasn't changed much from July to September, but of course, that fuel inflation growth has been very strong, and a lot rides on the way in which oil prices, which have picked up recently, how they play themselves out over the next 3 to 6 months. Pressures are also coming from producer prices and shortages of material. The left-hand side, I'm showing you what intermediate manufactured goods and final manufactured goods prices look like. Those are those green and red lines relative to CPI goods, which is the blue. And then on the right-hand side, from the BER survey, firms, the point that's been made by them is that there's a shortage of materials that's emerging as a constraint to business activities. And like in other parts of the world, we are watching very closely to see how these producer prices end up feeding through into consumer prices, which is what I'm showing you here. This is headline inflation, the way it's played out over the last few years relative to the midpoint of the target, and then what our forecast looks like. Now, it's reasonable to say, well, you've got these very strong producer price inflation measures, so how do you get to this kind of benign headline view? And this gets back into this thing I flagged earlier on in the presentation about the divergence between headline inflation and core inflation in some countries. And so what's happened in South Africa to some extent, as in others, is that we've benefited from lower services inflation and lower core goods inflation, and that's what I'm showing you on the left-hand side chart and the right-hand side chart. Things like total housing inflation, which is that gray line, has played a very strong role in pulling down for some time now that overall inflation rate. Services inflation tends to be quite sticky, sitting at around 5 to 6%. And you can see how that's come down. That's the red line there on the left-hand chart. Also playing the role is how the average level of wage settlements has moderated, and in particular in the crisis has fallen. That's that blue line. So the average level of wage settlements has come down very steeply to something like 4.5%. So in other words, collective bargaining agreements are reflecting this new lower inflation rate, and that's very helpful. And that's generating a unit labor cost, which has been quite volatile around 2020 and 2021. You can see that on the right-hand graph with the green spike, but has generally speaking been pretty moderate, and so has not been adding strongly to inflation pressure. And things like wage settlements and the exchange rate, among others, services prices, are some of the underlying fundamentals of the core inflation rate, and I'm showing you how they're diverging from the headline number. The output gap has also been revised as part of the GDP revisions. You can see the difference in them between the March MPC meeting and the September MPC meeting. It's a lot narrower, that output gap, than it used to be, but it is still marginally negative, and so therefore pulling down a bit on inflation as well. And of course, one of the kind of outcomes of all these numbers working together are inflation expectations, which we talk a lot about, and we make the point many times that inflation expectations being well anchored is an important part of monetary policy credibility. And you can see here nicely how inflation expectations have come down over the last few years and now hover around that midpoint of the target range, which is what we of course wanted it to do, to try to get it to better anchor inflation lower. Also playing a role here is the real effective exchange rate, which depreciated very strongly in 2020, which you would imagine as a function of the pandemic and the way in which capital flows exited the economy and currencies sold off, driving that red line down. But what we've seen is it bounced back up quite strongly. And in fact, our model estimates that it's slightly overvalued now. And so that real exchange rate is in fact putting a bit of downward pressure on inflation as well. All of these factors pulled together give us a forward-looking repo rate path, and I'm showing you that on the left-hand side. Our model that we use, one of the models we use, generates this repo path. So as the recovery occurs in the economy and as the headline inflation rate starts to pick up a bit, as you can see on the right-hand side, a normal Taylor rule wants to close the repo rate and get it back to a normal level. And that's what that QPM model tells the MPC, gives it guidance on how that might look given what we know of as economic shocks in the economy and the various gaps in the model. So that's my presentation. Let me just conclude with a few points and hopefully a few ideas for thought. I mean, clearly the stronger global recovery is there, but it will fade. And one of the big questions, I think, out there in the world now is, well, what are the future sources of economic growth going to look like? Certainly on our side, lockdown easing, strong commodities in terms of trade explain much of our very good recovery. But like the rest of the world, our growth rate is probably going to not stay at the very high levels it's at now. It will fade. And it's worth asking questions about what that fade will look like. What kind of terminal growth rates are we likely to see going forward? Certainly on the inflation side, I've shown you what strong demand is out there in the world, what supply bottlenecks are doing to keep price pressures elevated. And the open question there is, what will pass-through be? So how will this feed through into CPI? Will it be permanent? Will it have second-round effects? And a version of that, of course, will confront us So far our inflation rate is quite well contained, but there are broad-based upside risks that we need to watch very carefully. There are other emerging markets that are reacting to these things quite aggressively already, and certainly all of this would benefit from continued de-risking of the economy and improving the potential growth rate. So let me end it there. Thank you very much.
Thanks, Chris. We're going to invite questions and comments. Paul will field the questions and we'll bring them to me, and then we'll decide which MPC member would respond to that. Deputy Governor Chasivana can't be on camera. She's got some broadband issues, but she is on the line, so she will be voice only. Mpho, any questions that are coming?
Thank you, Governor. I would just like to say that I'll be taking 4 questions in each round. Right now, we have about 3 or so questions to start us off. Governor, the first question, it appears to be from Anonymous, and they are asking, has the lack of operation...
This also is going to be a problem, Anonymous, because the rule is that you must say who you are and the affiliation you have. Anyway, okay, proceed, Mpho.
Okay. Oh, it's going to be a bit of a problem because there are quite a number of questions so far from Anonymous. So, but anyway, the first question says, has the lack of operations at ports materially affected exports, given that agriculture is unable to export any goods? Then the next question is, what is the Reserve Bank doing to improve confidence in the currency, the Rand exchange rate? Then the next question says, could you please explain the relationship between the quantity of higher powered money, in other words, notes and coins in circulation, and prices? That's all that we have so far.
Okay, can you just ask Anonymous to say who he or she is, then we will answer his or her questions. Can we have other questions, please?
Okay, we have a question from Ganta, and the question on the ports was from Ganta. Thank you, Ganta, for clarifying that. Then we have a question from Hlanganani Gubeni, and they ask, is the average 2-year ahead inflation expectation to remain well within the target range, having declined steadily in recent years? I believe that's my 4 questions for now.
What is that question? Can you repeat that last question, Mpho?
No problem. Is the average 2-year ahead inflation expected to remain well within the target range, having declined steadily in recent years? And that was from Hlanganani.
Okay, I don't know, MPC members, if you understand. It sounds more like a comment than a question, this last one. Okay, Rashad, since you are the pedagogue here, can you explain to Anonymous the relationship between the high-powered quantity of money and prices? Chris, I don't know if you want to take the question on ports and exports, what the impact there had been. And then Fundi, can you deal with the question of confidence in the currency, please?
Yeah, thank you very much, Governor. Let me start. Well, as you know that, historically, when you did monetary economics at university, an important, I guess, equation that you learned is that, money supply times the velocity how much money moves in the economy determines the price level and real GDP. I think that what's important is that over the last couple of years, that kind of definition or a framework to determine prices in the economy has largely been abandoned, although there's a lot of explanatory value in understanding money supply. And that today, what determines prices in the economy is a broader set of issues like even wages, supply side pressures, demand in the economy. And one of the reasons why money supply and high-powered money, as you put it, has less of an explanatory power in explaining prices really has to do with the fact that because of technology, money supply became less of a predictor of inflation. People were using credit cards and other forms of payment, and were not entirely relying on physical cash. Thank you.
Thanks. I'm not sure I have much of an answer for the port story. It's certainly true that in July, with the unrest, that exports took a very large hit. My guesstimate would be that would be something like 100 billion rands of exports didn't go out. But I'd have to check those numbers. From an agricultural point of view, agriculture goes out through lots of different channels, much of it actually on airplanes. So I'm not sure what the specific role of the ports in the agricultural export profile would look like. Thanks.
Fundi, confidence in the currency.
Governor, can you hear me?
Yes.
Okay, I can't hear anyone, but if I see nods, I will proceed. Just in terms of protecting the currency of the value of the currency, there are two issues that I want to highlight. So the first is protecting the internal value of the currency. And this is the role that we play as the MPC. When we're talking about keeping inflation low, that is the function that we are performing in terms of ensuring that the rand in your pocket retains its purchasing power over time. So if inflation remains within its target, we believe that value of the currency and that purchasing power will be retained and sustained over time. Then we have the element of the external value of the currency. And this is affected by a number of areas. So the first would be, what is the interest rate differential between South Africa and some of our trading partners? And this affects the flow of capital into the country. The second element that would also affect the value of the currency, which is also driven by capital flows and how the South African rand is viewed relative to other currencies, is the issue of confidence and investor sentiment towards South Africa. And that is generally affected by issues such as the policy settings in South Africa. It is affected by what is happening to our domestic growth rates. Do investors see our countries as an attractive destination to invest their cash in? And those elements, and sometimes there are political factors that will also have there might be political factors that will affect how investors perceive South Africa. And those elements would then result in shifts in the flow of capital, and we might see the rand being sold relative to other currencies if we are starting to see capital flowing out of South Africa. And we as the South African Reserve Bank do not control all of those elements that will affect what is happening to the rand. That is a broader policy conversation. It's the actions that the whole of government take that would have an impact on confidence, that would have an impact on overall capital flows over time. And this is something that the Treasury and the Reserve Bank discuss quite regularly in terms of what are the policy settings, what are the steps that we should be taking collectively as government to reduce our level of vulnerability and to make South Africa an attractive investment destination, among others. So let me stop there. Thank you very much, Governor.
Thanks, Fundi. And of course, constitutionally, our responsibility is to protect the value of the currency in the interest of balanced and sustainable growth in the Republic. That value of the currency doesn't, what matters is what the rand buys at home, not what the rand buys in New York, or it buys in Hong Kong, or it buys in Frankfurt, or in London. What the rand does in the foreign exchange market could affect the price formation dynamics in the South African economy, and that is what we would focus on. We do not target the exchange rate, so don't ask us what we are doing with respect to the exchange rate, because our responsibility is to protect what the rand buys in South Africa. That is our constitutional mandate, and that necessarily means that we must maintain price stability and keep inflation in check. Tijin, I didn't refer any question to you. The questions were too few. Is there anything you would like to add?
Not quite, Governor. I have seen newspaper reports of significant backlogs in the ports that are affecting agricultural exports. I don't have hard evidence and data for this. I've seen these newspaper reports, but that would be quite worrying for two reasons. One is agriculture has been a stellar success story in driving exports, and two, agriculture is much more labor intensive. It might be that the boom in commodity exports are masking underlying problems in the export of softer commodities. And that would be a sad thing because these are much more labor intensive. But again, I'm speaking on the basis of newspaper reports, Governor.
Thank you, Kuben. Mpho, back to you.
Thank you, Governor. We have two questions on prices, consumer prices and inflation. The first one is from Anthony S, and they ask, why only consider consumer prices when measuring inflation? Asset prices will be a far better measure. And that's Anthony. Then we have another question from Mark Hyman from Financial Services. And Mark says that at the post NPC decision, medical inflation was forecasted at 9%. And also there was announcements from Discovery Health and Momentum and the likes saying that they will not increase prices until May, June of next year. His question then is, reducing increased effect on medical inflation of the largest schemes in SA is well above 6%. How do you perceive this remedying the inflation forecast? Then we have a question from Andrea Masea from Morgan Stanley. And he says, Governor, what do you mean by needing to rebuild policy buffers coming from an unanimous decision to hold the repo rate steady at the September NPC meeting?
Can you repeat that question from Andrea?
Oh, okay. It seems more like a clarification question. He asks, what do you mean by needing to rebuild policy buffers coming from an unanimous decision to hold the repo rate steady at the September NPC meeting? We also have another question from Hlanganani Ngubeni, who asks, when is the repo rate anticipated to start picking up in view of SA's sharp economic recovery? And those are the four for now.
Thank you very much. Start with Anthony's question about why we would focus on consumer prices rather than asset prices. Consumer prices affect all of us. We are all consuming. And by asset prices here, I would take it that you are referring to the prices of financial assets. And those are driven by completely different dynamics. They do not reflect what the inflation rate that is faced by the general public entails. As you would know, we are not the responsible authority for calculating inflation. That is the responsibility of Statistics South Africa. And they compile the consumer price index based on expenditure patterns in the economy. And it is that consumer price index that is used generally, whether people are asking for salary increases or they are increasing prices of this product or this service. That is what they look at. Consumer prices are a generally used measure of inflation across the globe, and almost all central banks, that is what they are targeting. They are targeting some measure of consumer prices rather than asset prices. Should central banks be concerned about asset price inflation? Of course, we should be concerned about that. But when we get concerned about asset prices, it is more for financial stability reasons rather than because of inflationary reasons. Because we do know that when the prices in the financial assets have deviated from fundamentals, you do have a build-up of bubbles, and when those bubbles burst, they have got repercussions for the financial institutions and repercussions across the financial system that might actually affect economic activity. And as such, we have got a responsibility to preserve and promote financial stability, precisely because financial stability is also important for balanced and sustainable growth. I would leave the other MPC members to deal with the issue of medical prices and medical inflation. Tlanganani, you asked the question, when is the repo rate going to go up? Well, those decisions get taken from one MPC to the other. And based on evidence that gets presented at the MPC, together with the outlook for inflation and for growth, the MPC will reset its policy settings accordingly. So if you want to know what happens, you just have to wait for the next meeting, and the MPC will announce what the announcement is in either direction. But we can't in this forum say that this is when this thing is going to happen. Andrea, you asked the question about the rebuilding of policy buffers. You really realize when we talked about the rebuilding of policy buffers, we are talking about the rebuilding of broader macroeconomic policy buffers. And macroeconomics here is both fiscal policy and monetary policy. And of late, what has also become important had been the financial sector policy buffers. And as you would know, let me go through these three in turn and start with fiscal policy buffers. We got into the, if you could just excuse me a second, just excuse me, just a second. It is summer, so there is an afternoon sun that was coming through here. So I'm saying to you that getting into the crisis, South Africa didn't have policy buffers in as far as fiscal policy was concerned. We had the buffers in far as monetary policy is concerned, and in as far as financial policy is concerned. And so the response to the coronavirus shock by the South African authorities had been predominantly by using the other two policy buffers, being monetary policy and financial policy. Fiscal policy did respond, but in a manner that was not as free as monetary policy was. Fiscal policy was faced with constraints. We had debt that was rising. We had a deficit that was higher than it had been at the time of the budget. Last year. Next month, the Minister of Finance will table the budget policy statement, and I'm sure he will tell us how he intends to rebuild fiscal policy buffers. That is for the Treasury to deal with. And we must say that besides the conscious policy actions that had been taken, as the MPR refers in the analysis, South Africa did benefit from rising commodity prices towards the end of last year, and these rising commodity prices had actually resulted in South Africa being able to do fiscal consolidation faster than it would have otherwise faster than we would have otherwise been able to, and it was thanks to this overrun that came as a result of a positive terms of trade shock. In as far as financial policy is concerned, the South African financial sector does build capital and liquidity buffers. Part of it as a result of the Prudential Authority setting particular standards, part of it being the management and the board of the financial institution deciding that this is the regulatory requirement. We would rather keep a buffer so that if there is a shock, we do not fall below the regulatory requirements. As part of our response to the coronavirus shock last year, we decided that we would allow the financial institutions to fall below the liquidity coverage ratios in terms of as far as the banks were concerned, and in terms of capital, we allowed them to dip into the Pillar 2A buffers, I think it is called. And so, as we have a recovery, as the banks continue to lend, as you have credit beginning to flow again, it would be a matter of time for the banks to rebuild their buffers. Those are the policy buffers that we talked about. From the monetary policy side, we got into the crisis with a buffer that we had inflation closer to the midpoint of the inflation target range, and as Tanganani was commenting earlier on, with inflation expectations over the next 2 years anchored closer to the midpoint of the inflation target range. That gave us the space to be able to continue to provide support to the economy. And also last year we experienced a dysfunction in the financial markets. We had to restore functioning of the financial markets. We embarked on asset purchases and so forth. Those were measures that were taken during extraordinary times. And as normality returns, these measures would become difficult to justify anyway, and we are going to have to build buffers as inflation begins to rise across the globe. So that is how far I could take it with respect to the buffers. Other MPC members, anybody who wants to say anything about medical inflation and the lot? Who as the taker?
Yeah, I'll talk about medical inflation. Look, I'm not entirely sure I understood the question. we penciled in 9% growth for next year. That is in line with the long-term average medical insurance price inflation. We have a inflation for this year penciled in at about 5%. I heard 6% was the number thrown out there. So if we're below that, then you could probably add a very small margin, say 0.1 to our headline inflation rate if it comes out at 6%, but it'll be very small. Thanks.
Anyone who wants to add anything? None? Mpho, back to you.
Thank you, Governor. I will be taking the last 4 questions. The next 2 questions are around consumption and growth. Dali March asks, what appropriate structural reforms need to be considered for sustainable growth? Then Spamandla asks, it's good to see a strong pickup in household consumption expenditure in your forecast. What is your assumption about the SRD grants and or possible introduction of BIG in your forecasts? Then Lindley Donley from the Business Day has a question on expenditure outlays, and they ask, the governor in his opening remarks noted that risks of making large expenditure outlays based on the current commodities boom. To what extent does the governor believe that South Africa is at risk of going down such a path, and what should be the dangers for SA if we were to make this mistake? Then the last question is from Rizwana Sumat from Nedbank, and they ask, is the MPC concerned about any impact on SA CPI or exchange rate performance should it continue to hold the repo rate steady in an environment in which global rates are rising?
Thank you very much, Mpho. DG Naidu, if you could deal with the issue of the appropriate structural reform and the impact on balance and sustainable growth, I would very much appreciate that. Rashad, can you deal with CPI and the exchange rate, please? And then I will take the remaining 2 questions.
Thanks, Chair. Chair, let me start off by saying that different people mean different things when they say structural reform. We've used the term, and in the main, I think we're talking about 2 or 3 things. But before that, let me put a precursor to that. Our general view is that sound monetary policy is a good thing, but sound monetary policy doesn't have much influence on potential GDP. Sound monetary policy can help cushion the economy during booms and busts, but it does not have much influence on potential GDP. Structural reforms can raise potential GDP. The long-run structural reforms are obvious. They're to do with education, they're to do with the quality of life of people, they're to do with access to public transport, housing, and the kinds of services that make people productive, but particularly education. The short to medium run structural reforms in the first instance are around energy. South Africa faces significant energy constraints. In the second instance, there are many areas of public policy which push up prices, which affects the economy as a whole. We see rates and taxes rising regularly. We see, water, electricity prices. We see school fees, university fees rising regularly. All of these things put upward pressure on the cost structure of the economy. And in the second instance, it's absolutely critical that we introduce reforms that address the cost structure of the economy to be able to bring down the cost structure of the economy. Chair, there's a range of areas where I think reforms would enable investment. Certainty about the green transition and a just transition to a green economy, I think would crowd in investment. Sound spatial planning would crowd in public and private investment. We think, and it is the view of the central bank, that in general, there may be exceptions, but in general, tariffs push up the cost structure of the economy. They make it more difficult for the poor to consume. Again, there may be some areas where it's justified, but in general, these are cost-raising issues. So, Chair, I would say that those are some of the critical areas. Energy, spectrum, broadband, efficiency of production, the cost structure, the cost of doing business, the quality of services and pricing at local government are all structural reforms that all could give you significant leverage on growth in the short to medium term, Chair. Thanks.
Yeah, can I come and go? Yeah, I hope
Yes,
I hope I understood the question, but let me answer it nevertheless in the way I thought the question was being asked. I mean, I think that, you know, the question is if the monetary policies of many emerging markets are such that they tighten, and they have tightened while we've kept our monetary policy unchanged, what implications will that have for South Africa and ultimately for the CPI? I think that the one thing we have to take into consideration is it's obvious that we are an important destination where we compete with some peers, at least in investment is concerned in the bond markets to a limited extent or more so in the equity markets. But I think that the real question is, you know, why is it that some emerging markets have tightened and what explains their own, in the way we like to put it in MPC speak, is a reaction function? And is it the fact that they tightened will have an impact on our exchange rate because their tightening leads to more capital flows going in that direction? Now, that's a very bold statement. At the end of the day, they're tightening because they're exceeding their inflation targets. Their bond yield curves may have a very different structure, and it depends where capital is coming in, at what level of maturity. So, you know, one can't make the assumption that capital is flowing to emerging markets that are necessarily tightening because of their own inflation profile. However, what I can say is if you make the assumption that that tightening in emerging markets will lead to capital flows away from South Africa, and that's an assumption, naturally that could affect your exchange rate, but will it affect your exchange rate persistently? Will it, and in the end, what impact will that have on the CPI? Will it be a persistent? Will there be second round effects? These are all imponderable. So we essentially, you know, left with two issues. What is it about our own stance relative to other countries that will lead to capital flow away from us, and in the process, a depreciated currency? And there's a whole, you know, variables that we don't know. The second order of questions is that will that depreciation have an effect on inflation? And in general, you know, exchange rate depreciation does have an effect on inflation. The extent to which it has an effect, the second round effects, is often an empirical question. Thank you.
Thank you very much. I think that it's important to state here two things. The first question has to do with household income and basic income grant. It's very difficult to model it if you do not know what the level of the basic income grant would be if such a decision is taken. There are trade-offs to be made, and those trade-offs have to be made by government. The South African Reserve Bank has got its own mandate, so that question should be diverted to the government. That's not for us to deal with. In terms of expenditure outlays, I think that is very important that we learn from the previous commodity cycle boom. And South Africa was not alone. Many countries which are commodity exporters made expenditure commitments on the basis that there was a commodity super cycle and that this is going to last forever. But the laws of economics tell us that nothing lasts forever. The one thing that is permanent in economics is that the business cycle will always be with us, and at some stage that adjustment would take place. And there is a danger that South Africa, like many other commodity producing countries, could mistake the current commodity price cycle as a sustained cycle, and we might end up making commitments that we end up with us being in more debt and probably raising the country risk premium. But those decisions are decisions of fiscal policy that must be taken by the national treasury. We watch these to the extent that that stance feeds into the country risk premium and thus feed in the neutral interest rate, and that will be where we get concerned. But it is not for us to make those decisions. These things might be risk, but those decisions are for the National Treasury to make. Thank you very much. Paul, you said that was the last 4 questions.
Is there room for a final 1 or 2 questions?
Is it 1 or is it 2?
Let's go with 2. Let's go with 2 final questions, Governor. Okay, so the first question is from Spusiso Khoza, and his question is around digital currency, and he wants to know what are the SOP's plans around digital currency and fintech innovations. Then the next and final question is from Peter Arthur Montalto, and he says the MPR doc sounds alarm on CPI risks, yet doesn't quite answer the question of the likelihood of these being realized. And he asked, what is the assessment on that front? Thank you.
Thank you very much. Peter, central bankers have got a number of tools. Alarms and panic are not part of our tool set. And so when we identify risks and we say to you, there are the following risks with respect to inflation, we are not being alarmist. We are simply stating that should those risks materialize, inflation might rise. And should that happen, and we feel that there is a risk of those risks materializing, monetary policy will have to take steps to deal with such consequences. The monetary policy review, like the previous MPC statements, had come with an assessment on the balance of risks. And we have, as we have said previously, that the risks to the inflation outlook are on the upside, and we would continue to watch that. And South Africa is not alone in that respect. We have seen inflation rising globally. And in the presentation, we spelled out how we have seen, even in advanced economies, countries overshooting their inflation target. And the advanced economies can do this because for years they had struggled with getting inflation closer to target. That is not a luxury that emerging market economies are having. And I can assure you that the South African Reserve Bank remains vigilant, and to the extent that we think the risks could materialize, we will take concrete steps to deal with that. Rashad, if you could deal with digital currencies, whilst the other MPC members think whether there is anything they would like to add to what I have said.
Thank you, Governor. Well, South Africa is part of a community of central banks, some proactively, some reactively looking into digital currency. Many central banks are doing important research on digital currency on the one extreme. On the other extreme, some central banks have actual pilot projects where they experimenting in the field, like China, People's Bank of China, Barbados, and many others. And then there's those who are actually in what we call prototype experimental mode. We are one of those. We have a project at the moment where we're looking at digital versions of cash. That could mean many things. We don't have time to get into that. And this project will probably be completed in about 2 years' time. Once we complete the project, we'll then do a major assessment of which direction we want to go. Do we want to go the digital currency route? Do we want to go the what is referred to the conventional or non-conventional payments route? In other words, instead of digital currency, you modernize your payment system, put more effort into a competitive payment system, and so on. So we very much have a digital currency project. We spend a lot of time talking about it, but it is early days, and we are not only working on digital currency in the SARB, we have collaborative efforts with other central banks on multiple digital currencies across borders, and so on. So it's a big project. Thank you.
Anybody wants to add anything? Nada. Mpo, thank you very much. I guess that brings us to the end. Is for you to do your closing remarks.
Thank you, Governor. I just want to say thank you, everyone, for joining us today. This was indeed a very interactive session. Thank you to all of those who submitted their questions. We thoroughly enjoyed the session. We look forward to seeing you again soon at the next MPF, which should be in April next year. So till then, thank you again for joining us today and have a good evening.